Today, before we start, I'd like to say that officially last night I crossed 100,000 likes on TikTok. Yes, I'm fully aware that one video in 24 hours gets way more than 100,000. But for me, I'm pleased and thank you very much. So, yesterday we talked about First Brand. A lot of interesting comments on that. But before First Brand, like a week before, was Tricolor. Tricolor went into bankruptcy, okay? And we'll go through the whole thing, but it's already under investigation for fraud allegations. So the article goes through and says that, they're looking at the car loans and that JP Morgan and Fifth Third Bank have about $200 million in exposure apiece. But it's the last line that interests us. One area of focus was whether Tricolor pledged the same collateral on multiple loans two separate people familiar with the matter said. Sounds familiar, right? We just saw this again with First Brand. Now you can stop and read this, but I just want to point out that Barclays, they say, is listed as a secured lender. What does that mean? That means the money they lent, they secured against some assets. But what are we talking about here? That they've lent the assets multiple times. So what does Tricolor do? Well, they sell cars and specialize in providing financing to lower income Hispanic customers, often with limited or no credit history. But I read this in an article like 10 days ago. I don't know where I read it, but so I looked it up, okay? And it says that 69% of the customer base were undocumented. They had no social security number. And over 50% did not have a driver's license. Very interesting, right? Selling cars to a person who doesn't have a driver's license. And they go down again, the last line. It appears there's significant fraud in the collateral file that was used. So why don't we build a quick little narrative here? Not that it matters because this is basically done and over, but this is how I think, okay? So you lend it out to these low-income Hispanics. They have no quote-unquote documentation, okay? Along comes the new president of the United States, and as we know, there's been a tremendous outflow of people out of the country, either voluntarily or we give them a ride, okay? So you have all these cars with all these people. So what would you do? I know what I do. I'd leave the key in the car and I'd leave and I'd go back to Mexico. So they're immediately under cash flow crunch, to pay their existing debt. And when people start going in and trying and saying, what's going on here, they find that they double dipped on the collateral assets. And someone asked me saying, hey, I have a farm, I have my crop I borrow against, my machinery, maybe a mortgage, whatever, but it's only one time. Well, we'll talk about First Brand again, but let's talk about this. So think about what you do. You have a car, you're gonna sell it to somebody, so you're making a profit. They put money down, they're paying interest and principal, and they're paying it down. So that difference, okay, they can lend against. So there's two borrowers. The trick is, the fraud is, they don't tell the first guy what they're doing or the second guy that they have it out over there. So that's where the fraud is. But then yesterday, after the video, First Brand cash crunch intensifies. Now, if you remember what we said, that First Brand said they had $800 million in cash. But yesterday, they were transferring between banks, okay? So one bank to another bank, and they don't say what it is. Maybe it was the $800 million, I have no idea. But one of the banks that was transferring the money to somebody else said, whoa, you owe us money. They're reading the news, so they seized the money, okay? Just because it was coming through the system and it hit them, and they said, boom, it's ours. And by the way, this happens a little bit more often than you think. And you go to the first line there, finance entities that provided off-balance sheet inventory finance to the group filed for bankruptcy protection on Thursday. All right, now we know now that those 5 are all owned by the same gentleman, and he is the guy who is the CEO and the largest shareholder of First Brands. So he was lending to himself. Now, just for me, the interesting paragraph is the last paragraph, okay? They don't identify the bank that seized First Brand's cash. It's not clear. However, Wells Fargo and Truist have in recent years provided financing to First Brands linked to invoices, all right? So, look, bankruptcy is messy. You're going to lose money. So if you bought the senior bonds, okay, and now they're trading for 25 cents on the dollar, you may get 25, may get 5, may get 35. You don't know. You're not going to get something, okay? But then you get into this inventory trading. So in other words, this inventory financing is not handled strictly per se by First Brands. They're providing the product, okay, the vehicle. And so what you have to look at, you have to say, well, who was the dealer? And we know 3, Jeffries, Truist, and Wells Fargo, okay? So why? Well, they're going to be on the hook legally and probably for damages as this goes through. Now, were they defrauded? Yeah, they were. But when you're part of the machinery, they're going to pay the price. In my opinion, I am not a lawyer. I have no idea. In my opinion, that's why they mentioned it that way in the article. Okay, so there's fraud there. They're relatively small companies, but let's talk here just for a second, because I noticed last year I put up an anatomy of a market crash and it had like 82,000 views, and I reposted it last week and I got another 30,000, okay? So, and we talk about a negative liquidity event. And so let's just, again, go through what goes on here. So we don't know how much money, but I'm going to say it's fairly manageable given the size of our markets. But think of what is actually happening here. So we're going to make up these numbers. I'm just making them up, okay? So let's say that a bank, and we know they're all invested in private credit, bought, and let's, again, just round it, make it easy for us. Let's say they bought $1 billion worth of First Brand or Tricolor. So they get the 19% interest while they're only paying you 4% on your CD, okay? So they go belly up. $1 billion is now, poof, gone, right? It's not an asset anymore. Well, the bank borrowed against that. And the banks, on average, are 15 to 20% leverage. So it's not $1 billion, it's 15 to 20 billion. Now let's go to the other side. Let's say you're a hedge fund. Well, we know from OMFIF that the average hedge fund in America is leveraged 52 times, okay? So that $1 billion is $52 billion, okay? So you can see how, because of leverage, how this expands quickly. And then you have to take it and you look at the banks. I have no idea how big Truist is, but let's say, they're on the hook and it's $1 billion. Well, they could go bankrupt over that. Would Wells Fargo? No, okay? But their earnings would be impaired again, all right? So, and Barclays, again, involved with this stuff. So their capital is reduced. So if you're a bank and you lose, let's say, $2 billion, you're leveraged $30 billion. That means you have to sell like $300 billion worth of securities to get your money, get it back in balance, okay? So this is what we're looking at. So when you look at events and say, well, this is a negative liquidity event, does it matter? What matters is who owns that debt. Is it a bank or a hedge fund? What are they leveraged? And then what would they have to sell to make up that leverage? That's what you have to ask yourself. So these two aren't big enough, I don't think, but I'm watching. I hope you are too. Like and follow. Tell me in the comments what you think. And thank you for listening.